if you believe what I just said, that you and your family or causes that you believe in will use your money more effectively, I'd almost say you have a duty to try and avoid taxes because your lifelong work will be put to better use.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and I have a belief that everybody deserves and should have some kind of financial planning strategy. You hear me talk about tax planning and exit planning and business planning and fitness planning. Well, guess what? Today I've got Peter Culver, who is the co-founder of Freedom Financial Office. They are a multi-family offices. He's going to explain that to us, but they focus and specialize with the entrepreneur. We're going to talk about exit planning and tax planning as two key components here that I always talk about on the show. So, Peter, welcome to Ask the Planman. I don't know if I set that up properly. Did I cover you okay? Freedom Financial Office.
Beautiful. Thank you, Bruce. It's a pleasure to be here.
Absolutely. I'm thrilled to have you here. And we were talking a little bit as we were getting started about the whole conversation of supporting entrepreneurs and bringing tax strategies in their so-called exit planning. So let's just jump into that. I got plenty of entrepreneurs that listen to the show. They may or may not know in general what a family office is. So let's make sure we talk a little bit about that. But, you know, why is this such a high need, high demand? And more importantly, why is it so underutilized?
Right. So I would say two things. One, the terminology multifamily office, I think, covers two aspects. One, it tends to involve planning that encompasses a whole family in the sense of both horizontally, right, but vertically too. So-called multi-generational wealth planning. And fortunately, many of our clients have more money than they'll ever spend in their lifetime. And so how can they be thoughtful and how can we help them be thoughtful about passing that wealth along to their families, to charities that they're interested, those kinds of things. And then, too long a story for today, but my co-founder, Noah Rosenfarb, and I are entrepreneurs ourselves. And I think in the beginning of our careers, gravitated to the entrepreneur. You and I are probably old enough. I started doing business before any of this existed. And I was a lawyer when I first started out. And my favorite trick to get out of the office was to call a client and say, I want to come to your business and see what your business looks like, what we used to refer to as a plant tour. So I kind of just fell in love with entrepreneurs. We say in our company, they're the heroes of the economy. If you know the stats, there are far many entrepreneurial business than gigantic businesses traded on the stock exchange. And so those are the people that all over America create jobs and new ideas and stuff like that. So they tend to be positive, forward-looking people, and we love being around them. So we kind of picked that out as a niche.
Now, I appreciate that. Thank you. So when we get into estate planning types of conversations, again, for my listener, I want to break down why, when we're talking about, as Peter just framed it, when somebody has more money than they're ever going to spend, then you start to get involved with the estate taxation, the estate tax rules, the amount of money that can be passed legally, tax-free, tax-exempt, from generation to generation. And so when we get above a certain value, and that number does change year after year, there's threats.
Well, and I think that's,
sunsets.
as you know, that's a key point right now, right? Because the so-called exclusion from estate taxes right now for a married couple is about $26 million. That's a pretty big number. And there's way more people that are under that number that are over that number.
Right.
But that number is about to change in 2026 down to about $12 million per married couple. And so for anybody listening that owns a business and other assets that are, I would say today, worth north of $10 million, there's a high likelihood that you at least have an estate tax problem. The great thing about all tax planning is that paying taxes is voluntary. And we're not ever suggesting that anybody commit fraud, but there are many creative and totally legal things you can do all across the tax spectrum: income, gift, estate, capital gains, that you can do to minimize your taxes. And I think most people would rather give their money to their family or to some other cause that they're interested in than to the government.
Absolutely. I always say my jokes over the years is, what's the difference between tax avoidance and tax evasion, Peter? 15 years.
Well, and that phrase comes from a very famous, I'm a lawyer by training. It comes from a very famous Supreme Court case. And I forget the name of the justice, but essentially what he said is tax evasion is illegal. That's fraud. That's where we wear pinstripe suits. Tax avoidance using legitimate techniques is totally lawful. And we would say, if you believe what I just said, that you and your family or causes that you believe in will use your money more effectively, I'd almost say you have a duty to try and avoid taxes, because your lifelong work will be put to better use.
Absolutely. I mean, it's on my business card, death and taxes. We help you plan for both, or something like that. So it's,
it fits into your theme really of planning. I mean, you and I are both planners, maybe instinctually by nature. There's so many things that can be planned for, whether it's the sale of a business or reducing your income taxes last year or next year, or reducing your estate taxes. You can plan for those things. And regrettably, you and I both know lots of people don't plan.
No. Regardless of their financial status.
Sometimes it's inversely related to that.
I agree with that. So as a frame of reference for the listener out there, I started in the financial industry in 1986. In 1986, an individual could leave to their heir $600,000. A married couple was $1.2 million. Now, I don't know what the present value of 1.2 million is.
It's not 26 million.
it's so the fact that it's been increased over time. But if you think about, you and I have been in the tax strategy planning for the better part of our, my 38 careers, is, we're always talking and being proactive. Now, I'm from Central New Jersey, and clients had a decent net worth based upon, working in corporate America. The AT&Ts and Verizon was there, and all the pharmaceutical companies and Exxon and Mobil. And so, you had the millionaire next door up and down the street. So, they had a 401k of a good size. Now, home values have taken off in the last decade across the country. But, even before I moved to Florida 10 years ago, houses were $600,000 to $1 million, $2 million. So, 1.2 million, a lot of people was just their homes, forgetting their assets.
Right.
So, and then you show them, hey, you're 50 and your assets are going to grow for 40 more years, and you have a $6 or $8 million estate, and you could protect 1.2 million. We need to do some conversation on your estate planning. And I've been implementing estate tax strategies. Now, as the bar got explosively higher to the 10 million and the 12 and now 26, your clients kind of fall off the branch. Getting more and more of those clients is harder and harder. So it's not to scare the listener off, but what you're describing is now another rollback. There's been sunset provisions in the past that did get extended. That's how we got to 26, right?
Yeah.
And then I always have the Steinbrenner clause. Do you remember that?
Right. Sure.
So it was in 2010, I believe.
Yeah.
So in 2010, folks,
he died at the right time.
Well,
there was another very wealthy person who died that year in addition to Steinbrenner. I'm trying to remember who that was.
Well,
maybe somebody in the oil business or something.
Yeah, like a T. Boone Pickens type of guy, or somebody like that. I don't know if it was Ross Perot, but my joke, it's a joke, people,
right,
is Steinbrenner was in ill health, And it was the year that there was no inheritance tax. It was totally gone. And I jokingly say his kids put a pillow over his face.
Right.
And said, Dad, take one for the team. We're going to save billions in taxes. And they punched him out a little bit early to make sure he qualified.
There you go.
But that is just a joke. And I have no knowledge, nor am I accusing the Steinbrenner children of doing that.
I think,
but, that's planning. I mean, that's planning.
Well, but no one's going to be able to count consistently on that kind of situation that they would, die in a year when there are no taxes. And so you should take the bull by the horns and do some proactive planning so you don't have to count on that.
100%. I tell clients when we do the planning and they say, well, I may get an inheritance, or I'm counting on an inheritance. Like I can put it in there loosely as a potential, but are you going to, you're not going to take care of yourself and plan for 30 years because you might get something. What if they turn around and used it, lost it, spent it, and now you got nothing? Like that's not a plan. That's a wish. So when we come back to the family office structure, I guess let's give a quick 10,000 foot view. The family office is basically, from my understanding over the years, is when people get to a certain level of wealth, some might label it 100 million and above, a $250 million and above. I guess it's all subjective. Is instead of what most individuals do over the years is they acquire advisors. They get a tax person, they get an insurance person, they get a real estate person, they get an investment person. So they have all these resources, attorneys scattered.
Correct.
And so the way I like to frame it,
the silo factor.
Right. Nobody's in conjunction. And I always say, like, I'm the navigator. I'm going to bring everybody together as your financial planner, and we're going to get them all talking together. But a family office is that on steroids, if you will.
And the only thing that I would say is that in terms of the numbers, somewhat as a result of technology, you can bring to people that are not worth $100 million all of that integrated service at a meaningful level. And, now the people that you were talking about that owned a home that had a net worth of $1 million too, now they're worth $10 million if they live in northern New Jersey and they have a nice job and a pension and stuff like that. And those are clients that, at least the platform we use, can bring that integrated, coordinated planning to a client.
Well, not everybody needs what would deem to be a family office, but everybody needs the combination or the conjunction or the collaboration of these different advisors. Again, which is what I've done on my levels over the years is, Peter, you don't have a tax person? Let me bring somebody in. You know what? As we did your plan, well, these are your estate exposures. Let's bring in an estate planning attorney to help us figure out some strategies for you to implement. Like, what do you do with the house? What do you do with this? What do you do with that? And then if we need an insurance trust, an ILIT trust, or revocable life insurance trust, if you're going to do a credit remainder trust and want to do charitable donation, like just whatever it is that you're now implementing or suggesting to the clients, again, as a consult, what are you trying to do? How do what's your A and where you're trying to get to B, right? So I'm here, I want to get there. And then, by the way, we've identified through our tax strategies, like, well, and again, we're making up a number. You have a $5 million exposure. But if you do this, this, and this, we're going to save you that $5 million. Now, my question, million.
That's a specific area we're extremely active in. Something that we say a lot is, and I think it's true, it's not necessarily meant to be derogatory, but most CPAs put numbers in boxes. They call you up, they ask you to give them their stuff, they look through your stuff, they put it on the tax return, and they say, you owe X. Very rarely do they say, but if you employed the following strategies, and I can give you a couple of examples, you might significantly reduce the X. That's what the client really wants to hear. And so we look at ourselves more in the tax strategy arena. We don't do tax returns. We would refer that out, but we want to counsel the client about ways to make a significant dent in taxes that they might otherwise pay.
And as you're saying, it's blind spots they didn't know things they could do.
100%.
So when we talk about accelerated depreciation,
right.
And, buy your car in December and, pick up the depreciation and all the real estate tricks and things like that. And we don't have to go down the rabbit hole. But again, that's the kind of stuff is if you're dealing with your tax person only as a tax filer, right, a tax preparer versus a tax strategist, and you need to get, and look, it's not for everybody. Like, again, you're talking about, you're catering to an audience. The audience is an entrepreneur.
2 ideas that we've been using with great frequency really in the last year that might be of interest to your audience, if that's helpful.
Yeah, we need some nuggets.
So a high income earner, there is a strategy, and I'm going to oversimplify a little bit just for the purposes of today, but imagine that I could buy let me work backwards. Let's say someone made $1 million last year. $1 million in taxes. The government says that they could take, if they gave property versus cash to a charity, up to a 30% charitable deduction. So they could take up to $300K off of the million. There's a strategy where you can buy certain assets at a discount and then contribute them to the charity. So we used a strategy last year where the client wrote a check for $75,000. There was 4x advantage. They ended up making a charitable deduction for $300. So if we're in the 40 or 50% tax bracket, they saved $120,000 to $150,000 in taxes, but only cost them $75,000. So,
right. And it's it's a 2x. They
correct.
They doubled their money on that investment decision, correct. Right? So they spent 75, but they picked up 75 additional.
Another one that was popular with a lot of our clients in the news, it's officially referred to as the Inflation Reduction Act. Sometimes in the newspapers, more referred to as the infrastructure bill. Tucked away in the infrastructure bill are a number of incentives for solar energy installations and equipment. And what's really notable about that is, number one, you mentioned just a moment ago, accelerated depreciation. So solar equipment qualifies for that. You can do that. But on top of that, solar installations qualify for a tax credit, right? So if an average person thinks about your tax return, you add up all your income, then you do your deductions. Depreciation would be a deduction to get you down to adjusted gross income, and then the government says you owe X. But if you have a tax credit, then you say, oh, no, I don't, because I'm going to apply the tax credit against the tax. And so there's a program we work with that helps people invest in solar installations where they don't have to do a lot of work to get the benefit. They don't have to become plumbers or anything like that. And the interesting thing about the tax credit is, and it's specifically permitted in the legislation, is that if your numbers run right, and we'd have to run the numbers for a specific person, you can carry back some of the losses. So let's say you found out, oh, darn, it's 2024. What am I going to do about last year? There are situations in which you might be able to carry back, amend your return, and literally actually get a refund. So those are just a couple of examples of the kinds of things we try and do to help clients just take maximum advantage of things that are on the books.
Well, let's drive the point home, Peter, there's so much out there, and we always use the line on the show, you don't know what you don't know. That's why you got to keep listening to the show. Because we're going to keep telling you things you don't know. And so what you're identifying here goes in that same vein is you as a tax planning strategist are on top of things and bring that proactively, which is another buzzword of our show, is to always remain proactive. And so the proactivity is like, hey, what am I dealing with? What could I be doing differently before the door closes? When December 31st at midnight
Yeah,
rings,
and so
and it's
what
now
we do
January
there
1st.
with our clients is, I think most clients don't really think that much during the course of the year
Right.
about what their taxes are. And then sometime after December 31st, they get some note from their CPA and it says, send me all your stuff. And then in April, the guy or gal calls them up and says, you owe X. What we try and do is throughout the year, think of things that they might be doing during the year to minimize their liability. And we always ask them sometime, let's say generally after Labor Day, go to your CPA and get him to do for you what we call a tax projection.
Mm-hmm.
It won't be down to the penny, but you can usually pretty closely guesstimate if the rest of the year plays out the way it has so far. What am I going to owe in taxes? Well, if you do that in the fall, at least we've got some time to think about additional things we might do in a current tax year to reduce the taxes you'll pay in the following April. So you're absolutely right. And, you know, there's always new stuff coming out. We work hard to try and be able to be proactive. It's not like we just woke up every morning and thought of these brilliant strategies. There's a whole world out there of tax strategists who are constantly trying to think of completely legitimate but creative ways to use the tax code to the taxpayer's advantage.
Well, if people have no idea, the IRS tax code's about a book or a series of books that are like 6 feet high.
Oh yeah.
So most people at the IRS don't even know what's in there. So for somebody to go in there and cultivate ideas and strategies certainly takes time and ingenuity. So for people that would qualify to be the type of client, how are you guys compensated? Like, are you getting a percentage of the tax savings? Are you just a fee base, an hourly rate? Like, how do these things work?
Yeah. So two potential ways, and sometimes it's a combination of both. So many of our clients are ongoing planning clients. They're paying us some kind of fee on an annual basis. Some of the strategies I've talked about. So for example, the solar strategy is implemented by a group that takes all the heavy lifting off of the shoulders of the taxpayer. If we refer to that group a client that ends up doing that strategy, we get a small referral fee. It's nothing monumental. So it can be a combination, fully disclosed. The nice thing about that is, however, if the client is already a planning client of ours and they're paying us X a year to do their planning, and let's say we refer them to the group that does the solar, there's no additional cost to the client, right? So yes, there's a little bit of a referral fee inside it, but the client doesn't have to write another check to participate in the program. So that's nice. Okay.
And then for the listener out there, do you have a minimum that you tend to work with, whether it's a minimum net worth or potential net worth? Or how do you determine like where it's a good fit or not a good fit?
Yeah, so I would say certain of the more basic things that we work on, you know, a net worth of a couple $1,000,000. I would say, except with respect to estate taxes, where unless you have a net worth that puts you in the zone where you might have to pay estate tax, there's not much we can do for you. In some ways, the people that we do the most effective tax work are people that have really high incomes.
Okay.
Now, usually people who have high incomes have high net worths too, but
or high credit cards, one of the two.
Well, true,
because they overspend.
But, you know, those people are probably people making $1 million or more, something like that, where we can move the needle. That's
okay. So basically, for the listener, if the income stream, that's more the present and the now, you have a lot more influence in helping them eliminate current taxation. And then from an estate size standpoint, as we all deal with, I do a lot of estate planning work, is there's only so many tools in the toolbox. There's only so many things you can do. But you also mentioned about exit planning.
Correct. Good. I'm glad excellent.
And so before we part ways, I know you were on limited clock, but the exit planning side, now that's more strategic of I have a business, I'm building a business, or I've been in business for a long time, my kids don't want it, or I need to transition it to them. Whatever it is what's the best way to strategize proactively, maximizing value, and minimizing tax?
Correct. So I think there are two pieces to that. So I just mentioned a minute ago that the best candidate for us for income tax savings, surprise, surprise, is people who make a lot of income. We refer to a lot of our entrepreneurial clients as people who are rich, but don't have any money because all their money's in their business. But they may have in their lifetime that one transaction where they're going to sell their business. And I'd make two observations about that. One is really a non-tax observation. One is a tax observation. And it comes back to the theme of your show. Over and over and over again, we see examples of business owners that do not prepare effectively for the sale of the business. They don't even know what their business is worth. Some guy calls them on the phone and says, I'll buy your business for $10 million. And they get sucked into a process. We would say the effective timeline to really prepare a business for sale is probably 2 to 3 years to really get everything lined up. Now, in that arena, we offer a consulting program called Exit with Freedom, where we will kind of go shoulder to shoulder with the business owner and his family to have them have the most successful exit. Now, on a monetary side to that, another thing that we see a lot is the business owner gets focused on the price, which is the dollar number in the contract that the buyer says he's going to pay the seller. And what they never think about is how much of that money are they going to keep? And the biggest deduction is the capital gains tax, right? Minimum 23.8%, I guess, all across America. And depending on whether you live in Florida or California, it could be another 25%. So there are some great strategies to minimize and in some cases eliminate the capital gain tax on the sale of the business. They often specifically require some restructuring of the business, the ownership of the business. And so you need to start early, not 6 months before the closing. But that's an area we're very active in, is helping people keep more of the purchase price in their own pocket rather than slice off some of it and have to pay it in taxes.
I mean, taxes are going to be, everybody's always in their pocket.
Yeah.
So let's go back for a sec, because way you were talking and framing some of it. So the 2 to 3 year window, the why behind what Peter's saying is depending on the business and the structure of the business, but a lot of entrepreneurs use the business for things like their car, their health insurance. They're all about the tax deductions, which we were talking about earlier, not tax credit, but tax deduction. So you make $1 million and you find yourself in the 35% tax bracket, and now you're going to look for deductions. And so what can I do to bring that down? So you do the car, you do this, you do that. And then, so you're funding all these different vehicles, not physical vehicles, but items through the business. And so somebody like Peter's going to come in, and what they're going to basically do is say, look, if you detach these things you've been deducting, that's this amount of money. And now that's a 5x multiple back into the value of your business. Yeah, that's what we
call the add backs, right? So there's a good news, bad news here. The buyer does not want to pay for the seller's health insurance, car, pension plan, all that kind of stuff. So, okay, another reason to do some planning, because I got to make sure all that money that I get at the closing is going to pay for those things. But that stuff is, since this buyer's not going to have to pay for that, it increases potentially the profitability of your business. And so part of the prepping exercise is recasting your financials to show what they would look like if it was operated by a purely bottom line oriented
Right.
owner as opposed to a deduction oriented owner.
Right.
So that's
that's the lesson, folks. What we're talking about is why you don't just want to walk in the door, take a deal versus know your numbers, right? How often we talk about that on the shows. You got to know your numbers as an entrepreneur, business owner, and your profitability. And then, oh, by the way, I'm looking for an exit. Well, do you know the right multiple for your business? Is your balance sheet clean? Are you taking a couple $100,000 of expenses out that you really shouldn't, because now that's going to cost you another couple million? So that's where people like Peter come in and help you kind of get redirected, beef up those numbers, and assumably more than earns the fees that it takes to invest in building your balance sheet up better so
correct.
that you get a stronger exit. And
And
you have
often what we find is there's some small tweaks that can be made, either actual substantive tweaks or just little tweaks in the way the business, is presented financially. A classic thing is if you have a business where every sale is a one-off and there's no guaranteed continuing stream of income, that's not as attractive to a buyer, right? So what you want to be able to do is either show or create in your business what we call subscription revenue, right? I sign a contract and I got to cancel it before it stops. We have a case right now where the financials of the business looked like it wasn't a subscription business. They just recorded the money when it came in. It turned out the way they actually operated their business was a subscription business. So that's a little bit the optics of it, and making sure that their financials accurately reflect the way their business is running. The other thing that's quite common is what I call the distinction between the operator and the owner. So if I'm a buyer and I have a choice, I can buy a business where the guy who started the business, I don't need him after the closing. He's just kind of overseeing everything. That's a more valuable business than if I buy a business where all of the success is keyed to the founder. Well, in a perfect world, if whoever's selling the business is ready to get out, they want to make that transition because we can show them how much more valuable their business is. You can't do that in 6 months. You've got to find a successor, build a team, build a process where this business really runs, where you're more kind of like a non-active CEO and a group of other people are running the business. But that can take some time.
For sure. And again, these are the lessons there that we've talked about, or people hear, is if the business can't run without you, you're not in business.
Right, exactly.
You have a job.
Right.
You can't scale. You can't exit.
Correct.
Because, and I'm probably a good candidate for that, is, Weinstein Wealth Insurance Solutions. So I'm the face with my wife of the business. Like, there's no sales team. There's no, it's just the two of us. So what am I selling at some point? I can't scale unless I want to go hire 50 agents and grow the numbers, and then eventually have a management team and eventually position myself to get out from being the driver and the force of the business. So it's you can't have it both ways. It depends on your desires and what you want. But,
I'll just share with the audience. That's a whole nother subject. There are a couple of systems out there to help entrepreneurs run a business to get to that result. One is called EOS, the Entrepreneurial Operating System. We run Noah and I, my partner, we had 3 people when we started, him and me and an assistant. We have 21 people today, and we're not totally there yet, but we're intentionally trying to get to a structure where we don't operate the business on a day-to-day basis. We have a CFO, a COO, what we call a CXO, a client experience officer, and then support people and salespeople and things like that. So it can't happen overnight, but it can be very valuable to the success and the value of the business.
So that's a good tidbit for or a good takeaway for the smaller the smaller up and coming is using an EOS system if you're looking to scale or grow.
There's a website. There's a famous guy, I can't think of his name right now, who created the whole system, and it's definitely designed for the emerging business owner, not the already successful business owner.
Yeah, how to get from A to A, A on the way to B.
Right. There you go.
Well, that's great. I'm looking at the clock, so I know you have to jump here. So,
sure.
Any closing thoughts before we wrap it up?
Well, maybe just, I think two things is one, in general, we do some work in the investment arena, but we always say to our clients, plan first, then invest, right? Strategy versus tactics. So that's the general idea of planning is so valuable. And there are people out there who know what you don't know, just like there's stuff that I don't know. And I would try to find somebody if I needed to know something. And then specifically in the area of taxes, sort of paying taxes is voluntary. We don't want to evade taxes, as we talked about, but there are a lot of cool strategies to avoid paying taxes creatively. And love to help anybody that would want to know more about that.
Terrific.
All right,
folks. So I want to thank my guest, Peter Culver, here again. He's with Freedom Family Offices. You want to give a shout out, phone number or website?
Yeah, so the website's easy, www.freedomfamilyoffice. My phone number is 917-697-4156. I'm kind of old fashioned and I'm always available. Just call me. So,
if you feel like you need a consult, you want to understand more about some of the different things we talked about, the tax consulting side, the exit planning strategies. Again, there's going to be a rollback from 26 million down to 12 million. If you find yourself in that category, you certainly want to get with Peter or myself ASAP there. If you're new and upcoming in the entrepreneurial world, check out the EOS system, Entrepreneurial Operating Systems. It's helped Peter and his business scale from 2 to 21 people. So it certainly could help you there. And I know plenty of consultants are out there at the ready that just implement and help you manage your EOS as well. So thank you, Peter, for joining us, folks. This is another episode of Ask the Planman. I please ask you to like, share, subscribe. If you have any questions, please hit us up at asktheplanman.com. Go to planman.tv, 844-PLANMAN. As always, Bruce at Ask the Planman. You need some advice, always get it right. Come Ask the Planman. Until next time, Peter, thanks again for being with us. We'll see you next time, everybody.
Thank you, Bruce. Enjoyed it.